let's start off talking about financial markets. Now, I haven't talked much about financial markets the last few weeks. At the end of December, I reviewed the financial markets, but I don't bring it up every single week because it was just more of the same, actually. It was just new record high, new record high, new record high. It didn't matter what the news was. It didn't matter what the economic numbers were. It didn't matter if we were in a pandemic. It was just new record highs, record highs. Now, this week is the first week we saw the reversal of that, and I've been warning you this was coming. That the markets were way overvalued, more overvalued than we've seen since 1929, prior to the Great Crash and Depression. And I told you that we were going to have a pretty nasty market, and it was going to happen relatively soon, and it's here now. This past week was a pretty historic week in the markets. We saw dramatic declines in virtually all the averages. Movements in the bond market, interest rates, cryptocurrencies. Panic has returned to Wall Street, or at least the beginning of a panic. And let's review what happened this week. And it all comes down to the Federal Reserve. As I mentioned, the reason why the market was at 37,000, wherever it was the fact that for years and years now, the Federal Reserve has been providing liquidity to the market in the way of zero interest rates, and in the way of quantitative easing, where they were printing $120 billion a month to buy U.S. Treasury bonds and mortgage bonds and all that. And they kept the market going higher because this money had to find a home somewhere. It kept interest rates in the bond market artificially low. It certainly kept savings account interest rates ridiculously, infinitesimally low. And it just propped up the stock market. So now we're starting to see talk of the reversal of that. As a matter of fact, it's actually started. The Federal Reserve has tapered their bond purchasing. I think they're down to $60 billion a month, and by March they'll be down to zero. And now there's talk of going the other way, quantitative tightening, which means the opposite of what they were doing. Now they're going to be selling all these bonds that are in their inventory or on their balance sheet into the market, which I'm very curious to see how that's going to work. What's going to happen to interest rates, what's going to happen to financial markets in the face of that. Because you can't take the heroin away from the addict without the addict crashing. And we're starting to see the realization that in the financial markets, namely the stock market especially, that the party's over. So this was the third straight week we saw losses for the S&P 500. It's the longest losing streak we've seen since September 2020. And every time there was a bounce, and this is the real concerning thing about the markets last week, every time there was a bounce, it was sold. And for almost every day, there was only 4 days in the market last week. I think every day the market closed at the low. So late in the afternoon, there was major selling that hit the market. You don't want to see that. You don't want to see strength in the morning. The market, Thursday, the market Dow was up 400 points in the morning, closed down 350. That's a huge swing. That's almost an 800-point swing. And most of it late in the day as the sellers showed up, institutional sellers especially. Last week was the worst week for the Nasdaq since March of 2020 when we had the big crash for the COVID. Russell 2000. The Russell 2000 is smaller companies. They're getting hit the worst. They had the worst week since June 2020, and the S&P and Dow had the worst week since October 2020. And the Nasdaq, which has been the big driver of stock movements and index movements, led by the Apples of the world and the Microsofts and all, they're very technology laden, and the big tech stocks are the ones that have been pushing these index. And now the Nasdaq has its worst start to a year in the last 30 years. Let me say that again. This is the worst stock market start of the year for Nasdaq in 30 years. And it's very slightly worse than 2008. We know what happened in 2008. So the Nasdaq is down 14% from its highs. That's called a correction. Whenever you go 10% off your highs, that is called a correction in the market. When you go 20% or more, that's called a bear market. Now, it depends on how quickly these things happen to determine whether or not it's a crash or not. I mean, you could have a bear market where you're down 20% over the course of the year. That's not a crash. A crash is you're down 20% in the month. But right now, we're down 14% from its highs, the worst we've seen. The S&P is down 8.1% from its highs, and the Dow is down 6.7% 75% from size. Now, the reason is the Nasdaq is doing so bad because of technology. These big stocks, the FANG stocks, they used to call them, Facebook, Apple, Netflix, Google. You could throw Microsoft in there. You could throw Tesla in there. These stocks have moved the markets and the indexes. You didn't call the S&P 500 the S&P 5 because those 5 stocks make up something like 25% of the index based on their market capitalization. And when they were going up, they were pulling these indexes up. The problem is not all the stocks in the S&P 500 were going up the same percentages that these big tech stocks were going up. Now we're seeing major declines in stocks in the Nasdaq. We're seeing the biggest names in the Nasdaq get hit. This week, Netflix was down 20% on Friday morning. 20%. I mean, this is a huge drop for a company as big as Netflix. They came out Thursday night. They announced their earnings. Their earnings were pretty good. But their forward-looking statement about subscriptions going forward, what they expect to sign up and so forth, were very disappointing. And any stock that's overvalued, like some of these stocks are, any negative news hits them. So in the FANG, the N really hurt it. And we're starting to see panic accelerate. When you see markets close at their lows, people want out before the close. And we saw that virtually every day. And I think the downturn has some more to go. We may see a little bit of a bounce early in the week, but I don't think we've seen the bottom in this market yet. And a big determinant of that is going to be what the Federal Reserve says at their meeting. They're meeting on Wednesday, and there's some concern that the Fed's going to be more aggressive in cutting their tapering of asset purchases and money printing, and more aggressive in deleveraging their balance sheet and selling bonds into the market, taking that money out. So think about it. When you buy bonds, when the Federal Reserve prints money and buys bonds from these Wall Street banks, that money was not in the system before. And now these banks have the money. And that money finds its way into assets. That asset could be the stock market. It could be cryptocurrencies. It could be bonds. It could be real estate. But the money has to go somewhere. Now, when they do the opposite of quantitative easing and they do quantitative tightening, where they're selling their bonds back to the banks, that takes money out of the bank's hands. And where does the banks get that money from? By selling the assets that they bought prior when they had quantitative easing. So now they're going to be selling stocks. They're going to be selling bonds to give that money back to the Fed. Now, it would be interesting to see how aggressive the Fed is at this Wednesday meeting. Now, my thoughts have always been, and a lot of people on Wall Street do, that as soon as the market cracks, the Fed's going to back away. The last thing the Federal Reserve wants, any administration in an election year, wants financial markets to be crashing. And what we saw the last couple of weeks is really a slow motion crash, and this can very well accelerate. So does the Fed want to say anything on Wednesday that's going to exacerbate a very weak market? I don't know. I don't think so. But then again, with the inflation problem, maybe they want to make a definitive statement that, hey, we are going to battle inflation. And the Fed has a no-win game here. They really can't win. If they don't raise interest rates, inflation becomes very aggressive inflation, worse than we're seeing now. And if they raise interest rates in any significant way or pull liquidity from the system through quantitative tightening, they exacerbate a crash of financial markets and the economy and real estate and everything else. So I don't envy Jerome Powell, but he really is painted into a corner here. And it's going to be very interesting what he says on Wednesday. And the markets next week, this week coming up, is a pivotal week for the stock market. It easily can break down big time, or it could stabilize, or even reverse. You never know here. It all is going to depend on what the Fed says on Wednesday. So they have a meeting. I think that it would be an incredible surprise to financial markets if the Fed raises interest rates on this meeting. It's not expected. And the Fed does not like to surprise markets by doing something that's not expected, especially as fragile as the stock market is right now. So I don't anticipate that. It's really what they say going forward. It's what they say at the press conference. afterwards. This is something relatively new. After the Fed meets, the chairman comes out and does a press conference with financial reporters and answers questions. That's usually more telling to the market than what the Fed statement was from the meeting, because he's asked direct questions, and he could say things about we're intent on battling inflation, we'll do what it takes to do so. That would be adverse to the financial markets, the stock market. We'll sit there and react to that statement. And it's amazing how quick they react. So it's all up to the Fed right now. The Fed certainly doesn't want to crush the markets, but at the same time, they know they have to do something about inflation. And the market's going to be waiting with bated breath to see what's going to happen with the Fed. And we'll see this week, and we'll be reporting it to you next week, because it is the big financial news of the week. Now, for the week, the Dow lost 1,640 points. Now, the Dow has been the strongest index right now. It is the biggest companies. They didn't get overinflated from like the tech stocks have been. A lot of tech stocks don't earn a whole lot of money compared to the Dow stocks, the 30 industrial stocks that have dividends and everything else. So they've held up well. The Dow was down 4.7. Now, these are pretty big declines for a week. The Dow was down 4.7% for the week. For the year, it's down 5.7%. Now, when I say the year, we're talking 3 trading weeks in January. In 3 weeks, the Dow's down 5.7%. The S&P 500 for the week, and again, I can call this the S&P 5 because the big tech stocks are part of this index as well, down 5.6% for the week, and down almost 8% in January. Now, the Nasdaq is the index that's been hit the hardest because of what I said, these overvalued tech stocks. And tech stocks are very susceptible to interest rate increases. They're very interest rate sensitive. The Nasdaq for the week was down a whopping 7.5%, and for the year down 12%. Again, the year being 3 weeks. So if you're a Nasdaq investor, if you're an investor in these big stocks, you're taking it on the chin right now. And I don't think it's over. It's not over. Fair market value on the Dow is 18,000. And I think we're going to get there. I don't think we're going to get there in like 3 days, hopefully. That would be a mega crash, which I don't anticipate unless there's some kind of black swan event that happens, invasion of Ukraine, maybe. We'll talk about that later. So keep an eye on the stock market. I've been warning you for months about this. If you're overexposed to the market, you have to take protective measures right now. You got a lot of profit still in the market. If you're overexposed, and for people who have a diversified portfolio, have both stocks and bonds in it, because bonds have performed very poorly, interest rates have been so low, and stocks have performed so well, you're out of balance. You have too much stock market exposure. So say initially you wanted 40% stock market exposure, and now you're at 60. Well, you got to bring that back down to at least 40 by reallocating, rebalancing the portfolio. I see new clients every week that come to me with way too much equity exposure. And thankfully, over the last month or so, I've taken new clients millions of dollars out of the market and moved into a more conservative posture just before we start to cut this downturn. So their timing was great. But, you still have time to lower the Dow is still at, 34,000 change, 35,000? I don't even know. So it's still at really elevated levels. You still have huge profits there. Don't give them back. And that's the biggest sin that investors make. They make a lot of money, they get too greedy, and they don't pull back. Now, how do other markets do? The bond market initially, the treasury market has spiked recently in yield. The 10-year treasury touched, I think, 1.9% earlier this week. Since then, the yields have come down somewhat to, I think it's 1.72 or 1.73. What does that tell you? It tells you the bond market is calling the Fed's bluff right now. They don't really think they're going to be that aggressive in raising interest rates. But we'll see. Let's see, what other markets? Cryptocurrencies got destroyed this week. As we've seen cryptocurrencies soar last year, we're seeing the opposite now. Bitcoin is down 20% last week. It was the high, if you recall, was like 65,000. Last week on Monday, a Bitcoin was 43,177. On Saturday morning, it was a little over 34,000. That's a huge decline. But worse than that is the second biggest cryptocurrency, which is Ethereum. Ethereum on Thursday was $3,272. On Saturday, it was $2,327, down 28%. So we're seeing people flee risk assets. And the thing about cryptocurrencies, they're very correlated to risk assets, like the stock market itself. And we're seeing that. We're seeing the threat of higher interest rates are negatively affecting the cryptocurrencies. It was just a few months ago that cryptos were at all-time highs. And all the people invested in Bitcoin and everything were just gloating about how much money they were making. And unfortunately, that sucked a lot of other people in, in the $50,000 to $60,000 range. And they're sitting here looking at Bitcoin kind of disappearing from under them. And we have a liquidation panic going on right now. And we've seen over $1 trillion in market value destroyed since the peak. So it's a pretty ugly world out there for cryptocurrencies investors. Now, do I think it's going to zero? No, I don't. Cryptos will find a level that is reasonable for them. Is 65,000 it? I don't think so. But you could see how much risk there is in cryptos. They want you to believe there's no risk in them, and there is. There's huge risk in cryptos. What's holding up good, and actually had a little bit of a breakout this week, is precious metals, which have lagged certainly cryptocurrencies in the markets in general. The gold closed at $1,836 an ounce. Highest level I think it's closed in a number of months. Silver was up 6% for the week at $24.34. It looks like the precious metals now are ready to have their day. These are assets that never got overvalued. As a matter of fact, are probably some of the most undervalued assets on the planet, especially silver. And now we're seeing mints can't keep up with the demand. We're seeing the highest demand in many, many years for gold and silver coins. Dealers are having trouble inventorying stock of this, and it looks like that's probably a good area to be in. And why wouldn't it be? You're in an inflationary environment. You have the dollar being debased. Like I said, I don't think we're going to see aggressive interest rate increases by the Fed because they can't do it. The most bearish, the most hawkish meaning tightening analyst on Wall Street see a 1% increase in interest rates by the end of the year. So we go from 0 to 1%. Big deal. 1% ain't going to do anything for inflation. It certainly will hurt the housing market as we're starting to see mortgage rates go up, and we're starting to see mortgage rates go up. It's going to hurt the government's borrowing costs, that's for sure. But the Fed's lying. Whatever they say, I don't think they can go more than 100 basis points. A basis point is 1/100th of a percent of interest. So if you hear somebody say 50 basis points, that means 0.5%. 25 basis points, 0.25%. 100 basis points, 1%. So I don't think we're going to see the Fed raise more than 100 basis points because the markets are going to take a tantrum. The economy is going to take a tantrum. And it's not going to do anything to fight inflation. 1% interest rates are not going to fight inflation. It's like taking a garden hose trying to put out a wildfire. It's not going to work. And I mentioned it many times. We're in an inflationary environment now, if calculated the way it was in 1980, where we're almost at the same interest rates that we were then. And Paul Volcker had to raise interest rates up to 18% to quell inflation. 1% is quite a distance from 18%. And the Fed can't do it. So they're going to try to talk up a lot. They're not going to raise interest rates at this meeting. If they do, the markets are going to crash. But they're probably going to maybe do it in March. But they may be more aggressive in stopping their quantitative easing. And we'll see how the bond market plays that out. Because who's going to buy our bonds? And if they're going to be not only tapering their purchases, and they're going to go the other way and lighten up their balance sheet. Now you're going to have competition for the for the Treasury to buy bonds, because the Fed's going to be selling the bonds they bought all these years, and now the government's going to be selling bonds to feed our federal budget deficit. Now, the problem with the budget is most of it is non-discretionary. It's Social Security. It's Medicare, it's Medicaid. It's things that the government is contractually obligated to pay. It's mandatory spending. And another $1.6 trillion is discretionary spending, which encompasses defense and about everything else there is. The Education Department, Justice Department, agriculture, all that. And how discretionary is that spending? Do you think we're ever going to see significant cuts to our defense? To education? It's not going to happen. Our federal debt now stands at $29 trillion and counting. And that's 5.3% of our budget right now. It might not seem like much, but that's 4 times. Last year, I think it was $345 billion in interest payments. And that's 4 times what the government will spend on housing. 4 times what the government spends on K through 12 education. 8 times what we spend on science, space, and technology. And that's with interest rates at historic low levels. So if we have a 1% rise in interest rates this year, which supposedly is likely to happen, assuming the Fed doesn't get spooked by the markets, that would boost the amount of money paid on interest this year to $530 billion. A 2% point increase, entirely possible by 2023, according to pundits, would raise the interest payments to $750 billion. That's about as much as the government spends on defense. And it's completely unsustainable. If they raise it 3%, and that's not unheard of. You know, historically, the average yield on a 10-year Treasury bond has been 5%. 5 to 6%. We've been, for the last 15 years, much lower than that. And that's allowed the government to continue to borrow and refinance our existing debt at such low interest rates. But apparently that's about to change. So we go 3 points higher to where we have a 3% federal funds rate, still low by historical, measures. The government's going to be spending nearly $1 trillion on interest expense alone, which will be 20% of our total tax revenue. And it's just about the same amount that we pay out in Social Security every year. So the Fed has a lot of bad options here. The Fed can print as much money as the government needs to pay interest payments, but that'll lead back right to inflation again, right? I mean, that's what's caused it. The government could put in place a gigantic tax hike. That's also known as political suicide, by the way, which seems unlikely. Another alternative is to cut spending, but there's no wiggle room there. I just said most of the mandatory spending and defense spending, there's only 20% left to pay for everything else in government. And by the way, there's a lot of agencies in government we should do away with. Education comes to mind. So we're looking at a true debt crisis in this country. The dollar's in peril. And I'm so curious as a financial guy, in this financial Wall Street business for 37 years, to see what the Fed does here and what happens based on what they do. The Fed today is not the Fed of Paul Volcker. The economy today is not the economy of Paul Volcker. The debt of the country is multiples as it was. And that allowed Paul Volcker to raise interest rates so aggressively. So, very interesting time in financial markets, interesting time for the Federal Reserve. In looking at the Nasdaq, the violent intraday reversals that we've seen in the Nasdaq, like Friday, are very rare and often happens during a crisis. This was only the 21st time since 1972 that the Nasdaq index rose more than 2% during the session early on, only to decline but close 1% or more. And the majority of those times happened during the busting of the internet bubble and during the 2008 financial crisis. So what is this telling us? Also, these major averages have closed below their 200-day moving average. What is that? It's a technical term. You average the price over the last 200 days of a stock or an index or whatever. If the index today is above or below it, it means something. When an index or a stock crosses above its 200-day moving average, that's very bullish. When an index or a stock closes below its 200-day moving average, it's bearish. And now the S&P closed below its 200-day moving average, and we've gone 490 trading days with the S&P above it. Very, very telling technical indicator. And in fact, all U.S. major indexes closed below their 200-day moving averages. Very, very tough time for the markets. Something that we have to keep an eye on this week. Very, very telling week for the markets. And we'll report it here next week on the Financial Physician. All right, let's take a break. 732-505-1160 is our phone number. On the other side of the break, I have a very exciting announcement regarding the future of the Financial Physician radio program. Don't go away.